generally, when it comes to deductions of a veterinary practice, there's basically like two buckets that I think people, should really think about. So the first is expenses that they're taking in the practice itself, and so that's like fairly straightforward. It's like, okay, anything that's ordinary necessary to the operating of the business are things that they should deduct. So that could be equipment. It should be any like conferences you're going to, any meals that you're having with people that are actually working in the business, and any supplies, all those things should be expensed. But then the other side of it is assets that you're buying for the practice that should be depreciated. And so that as I mentioned could be equipment. And so the idea behind that is if you buy even like a laptop, for example, for the practice, right now you would buy that and then you can deduct the depreciation expense of it. The new tax bill that just passed in July lets you depreciate the entire thing in the first year. And so what you want to do is just take a stock of all the assets that you've bought that have like a long life, and then do an analysis to determine whether or not all of those could be bonus depreciated, meaning depreciated all in the first year. And then when you could do that, you could generate a lot of losses that are not actually money coming out of your company, but really deductions that you could take to offset income, in the current year. So I think those are the, sort of big pieces. Well, there's one more, which is, maximizing the retirement account benefits that you can get, because those are deductions that you can also take against your income. A lot of folks maybe, don't maximize those. What we typically recommend for that is a solo 401k and, maxing that out. It's typically 23.5 K that you could put, per person in that as an employee contribution. And then as an employer contribution, you could do 20% of the net income. So that can just come straight out of the net income that you're paying tax on and put it into a retirement account. And that's a pretty big benefit. And then on top of that, there's other bigger retirement accounts that folks can set up called defined benefit plans. So, we can talk about that when that's a little bit more, meaningful, and, when income is like, quite large. There's really a structuring question. And so, embedded in that. So, just taking a step back, a lot of people who are running their practices are, running it, hopefully as an LLC. So you could run, you say I'm in business, you have a sole proprietorship, that's all you need. But then folks, move to the next level, which is setting up an LLC. And that's really not going to be a tax benefit. That's more of a legal benefit, so that, if anything happens at the practice and, you get to, to make sure that, it's only, focused on the business itself and not on your personal assets. So you set up an LLC. If you just have an LLC and not an S corp or LLC, in the form of a partnership, then reasonable salary and all of that is not really relevant, because you're not really paying yourself a W-2 in that scenario. You're just taking the profits of the business, splitting up amongst the partners, and issuing a K-1. And so that's just that. If you are converted that to an S corp or an LLC tax as an S corp, now you're in this world where it really matters what portion is payroll and what portion is owner distribution. And the reason for that is because there is, sort of a tax benefit in that the W-2 income that you're paying yourself through the S corp is getting taxed at self-employment tax rates, or on top of like the other tax that you're paying. But then the owner distribution is avoiding self-employment tax, which can be pretty meaningful, like 15.3% in certain cases when you're at certain limits. And so that makes it so that in an ideal world, you want to lower the W-2 income as much as possible, but you want to make that a reasonable salary amount. We'll do sort of analysis on as to determine what that is, but generally the rule of thumb is, how much would you pay someone in that position, if you were just to hire them, coming out of the organization, how much would you pay them? And so if that's like a set amount and that is supported by the size of the business and the size of the income that you're generating, then great. If the size of the income that you're generating doesn't support that income, it's lower, then, rule of thumb is, some percentage of your net business income you can pay yourself. And, like if you're aggressive, you can do a third. If you're, less aggressive, you could do a half. But we would do some analysis just to like make sure if that's, the right number, because, that's certainly the number that the IRS is really focused on. Think like, getting the most into your retirement account as much as possible is, pretty beneficial. Generally, that you get a lot of flexibility. You can convert that to Roth, or you can even contribute straight to the Roth. And so, there's a lot of benefits to sort of maxing those out. I'd say that sort of the way that we think about it is, so Low 401k is the easiest one to set up. It's, quite simple and straightforward. And, the calculation of when you contribute is very clear. And also the benefit is that for let's say the 2004 contribution, you only need to make that before you file your 2004 taxes, or 24 taxes, or 24. Um, and so, for example, a lot of our clients are filing their 2024 taxes in October of this year. They can still make the contribution for last year's 401k contribution, you know, today, or like, for the next month or so. And so that, sort of like cash flow flexibility is quite helpful. And so, Solo 401k is very, very, well structured for that. People set up defined benefit plans as well, because they, for example, right now want to get more than 70K into a retirement account this year. There's some, certainly a bunch of rules related to that, and particularly like who else is involved in the business. If you set up a plan and you have multiple people who are you're paying, then you actually have to, be mindful of like, how much capital you're giving to them as well. And so, that might preclude you from setting that up. But it's a case by case basis, and like the determinants are who else works at the business, and then how much net income are you generating, basically. I think in general, in a selling situation, there's sort of two types. So you're going to sell for some amount, and then there's that purchase price is allocated amongst two different types of assets that the buyer's buying. One is the assets itself, like an asset sale, and then the other portion is goodwill, or equity value. Basically, is kind of the mix. And so as the seller, what you want to do is make sure that as much of it is equity value as possible. And the reason for that is because the assets are going to be taxed at ordinary income. And so that's, a higher tax rate, generally like 37% federally, versus, the assets that is, deemed equity. Stock is, going to be taxed at like, 20%, tax rate, and not net investment income tax. So not the 20, not the additional 3.8%. So there's a pretty big difference, like a 17% difference between, the two treatments. And so as a seller, you're going to want to maximize as much of the goodwill as possible. And that's like, my client lists, my, IP, whatever else I've, built, like I want to maximize the value of that. Now, the issue is that the buyer has the opposite mentality. They want to create, more value in the asset itself rather than the equity. And the reason for that is that when they buy the assets, they can start depreciating those assets and get a tax deduction. So it is really this negotiation between, buyers and sellers, determining which, where you're sort of like putting the line on stock versus asset sale value. So, that's really the negotiation. And we've seen a lot of folks lower the price that they're selling the company at, um, in exchange for allowing for more to be equity value rather than asset value. So that's like the math that yeah, it is interesting to think about, like if you're close to a sale versus not. But I think generally the way that we think about it is, you know, operate the business as as if you're not selling. You never know what a transaction is going to hold. Um, And so if it does make sense to take the depreciation this year, time value of money, you're getting that deduction now. Maybe you can do more with that money by investing it or whatever. It's not just a strict calculation of like, oh, my when you sort of sell and then you have to recapture depreciation, that is a higher percentage rate versus what could have been equity value. Yes, there's math there, but I think the confounding variable is, oh, but time value of money. I would have taken that money, let's say 150K of incremental capital because I don't pay as much in taxes, put that into treasury account, stock, whatever, Bitcoin, whatever else, and there's some growth there. So it sort of like washes out. So I would say, don't think too much about like, you know, should I be like, optimizing the time, like of depreciation or not? Just operate your business as if, you could take the biggest tax deductions and benefits now, while it's very certain, and let the deal, sort of take care of itself, when it's time for the deal, basically. So certainly outside the entity, I think, because what you want to do is, well, like in general, like what's happening is the business is making money. Maybe it's paying you a salary, and then the rest of the profits are going to you personally. And then from there, all the other things that we do from a tax planning perspective is going to hit your, personal, and it's going to, offset that income that already came to you. And so doing real estate is, massively tax advantaged in many aspects. And so if that is benefiting you personally, that is offsetting, your other income as well. And so like, keeping it, sort of cordoned off and separate is, I think our preferred approach. And then specifically for real estate itself, when you are, there's like, a ton of tax benefits and, operating real estate, and we can go through all of that, long-term rental versus short-term rental, and like, real estate professional status with, maybe your spouse. Um, these are all things that we can talk about, in a more detailed way. But, generally just think about there's a lot of tax deductions that you can take, when you own real estate. And then in this particular case where you're actually leasing this to your practice, the way the interplay works is, okay, you're getting the benefit of the real estate as if you are renting it out to anybody else. But then the business that you are owning is paying the rent to the, other to your other business, basically. And so it's a deduction for your business. And then, it's income for this business. So like, that generally washes out, but you want to make it so that it's separated, so that, also you could sell the practice and keep the real estate. And, also like, maybe they want to buy the real estate. There's all these, different things that one could do. No major tax benefits to putting it all together, really. Generally, I think, you want to run the practice as, profitably on paper as possible. And then, like bonus depreciating and all that stuff, taking advantage of all the different, aspects that we talked about, like maximizing your retirement accounts, deducting everything that you can that is reasonable. Perhaps you get a business vehicle, maybe that's like, part of it. So, do everything that you can to operate the business in the most tax efficient way as possible. And so that's great. And then I think you do want to have like really good data, bookkeeping, accounting, like hire a good, bookkeeper and accountant, just so that books are really clean. Because in the, like process of a transaction, it is very, very nice to be able to, say, you know, hey, I'm, private equity folks, come in and say, hey, I'm, interested in buying your practice. If your books are very clean, you can just, be like, here you go, here's your data room, let's, uh, check it out. Everything's, above board, nothing, weird going on. And then it makes that process much more efficient. And then, then you also have like, you know, a lot of negotiating leverage because of what we talked about before, which is, the equity value versus the asset value. And, like your stuff basically, and you know what to ask for. A lot of these private equity firms are working with folks, or, and buying firms where people don't really know this. They don't have clean books. So there's like a whole process to get that going. Or, they don't know the difference between these two options. And then, they end up doing a big asset sale, leaving a ton of money on the table, and then sort of being, leaving a lot of money on the table for that transaction. And then I would say like one other piece is like, make sure the taxes are done right. There's a lot of mistakes that can happen in the tax return when you do that transaction. And so, the things that we do are, build models for clients in Excel so that we can like walk through all the different components of it. One particular thing that we talked about, very briefly is that, when you're selling your own practice, and a large portion of that is equity value. Some CPAs will include that in the net investment income tax calculation, and so you end up paying this like 3.8% tax on this big equity value when you don't have to. So definitely look out for these things, or hire people that are very well versed in these types of transactions, so that they can ensure that when you file the taxes, it's done at the perfect way, and minimize your tax along the way. So I'd say it's that. I think those are probably the key you know parts. I know you're managing so many different things in your life, including the business, and so just like keeping things clean is really the major advice that I would give. Generally, not really. So I think again, very very similar. Like let just optimize your business for your business, and like for in advance of a sale, like if they want to convert to an S corp, let them do it. Sorry, a C corp, let them do it. It's rare. A lot of partnerships, that folks are buying, they want to like keep the partnership experience, and especially if they're buying through a private equity fund. Um, so I wouldn't say there's like anything that one should do around structuring before a transaction. I think, think about the LLC conversion to S corp. Our typical, rule of thumb is that if your net business income after all the deductions and the retirement accounts and everything is 100K or more, that's the time to be an S corp. And so make that conversion, and like use CPA to start filing all that, and pay yourself for your salary and all of that, and that's it. Just writing like that. A C corp is double tax. It's not better for you, in your practice. And yes, there's a lot of talk about QSBS and QSBS optimization, but I think for this type of business, it's I think far better to be an S corp. Minimizing it is, if you are, what we talked about before, if you're close to a transaction and you're like, okay, I could either bonus depreciate this, or I don't need to. And then when I do the asset sale, that portion's cost basis is not as low, and I don't have to do as much depreciation recapture, which is at a worse rate, normally. But I would say, generally speaking, again, I think transactions are such a binary outcome. It's either going to happen or not. It sort of falls through at the last minute. There's so many things that can happen, and so I am of the mindset that run the business as if you are just running the business and no transactions happening. And so, in that regard, I would say bonus appreciate everything that you can. Take the tax benefit now, because time value of money and all those things that we talked about previously. The biggest one is what we talked about before, which is not recognizing the difference between asset value and equity value. And so, really, you want to maximize the amount of capital, or of the purchase price, that is allocated to the equity value, and minimize the asset value. And if you're able to have that conversation and negotiation with the prospective buyer, or oftentimes if you're selling to someone who's not aware of this, then you know you don't want to hose people or anything, but generally, it's our job to make this as well structured for you as our client as much as possible. So if they're not sort of recognizing the difference on their side, maximizing the equity value as much as possible is the right approach. So yeah, so this is like the key piece. I would be really knowledgeable about, and hire really good people around a transaction. You don't want to be penny wise and pound foolish on not hiring really good folks around the table around a transaction, because it can save you, hundreds of thousands of dollars, and maybe the cost is like, 5K or something like that. The, equity sale is taxed at long-term capital gains mostly, and that is, 20% federally. And the tax on asset sale is ordinary income. And if you're, high earner, which, I'm sure everyone is, it's 37% at the high rate. So, the difference between 20% and 37% is very meaningful. And so, that's something to keep in mind. It's really the transaction that we're honing in on. And so, I think that when one is selling, no matter who the counterparty is, your sort of biggest things that you're maximizing for is, the value of the purchase price, basically what you're selling the at, the allocation of equity and asset value, and then what's sort of happening after the transaction. So a lot of times when you're selling to a strategic or another practice, then maybe you're staying, maybe you're not. Oftentimes you're not staying. Maybe you're just giving, the business fully, and then you're sort of riding off in the sunset. And so thinking about, what that looks like. But for private equity sales, a lot of that is there's some earnout perspective where, you're going to get the rest of it after some, escrow period where you've moved all the clients over, you're going to work there for a little bit longer. And so really, thinking about what that post sale compensation structure looks like and when those things are getting paid. So the other interesting thing to note there is when you're doing this earnout, what folks can do is sort of allocate the purchase price over a period of time. Now, there are tax benefits in doing that because maybe you can get to a lower bracket, or you can like do more tax planning in the future, like charitable deductions or things like that, in future years to sort of optimize that. um, but also, like I'm a very big proponent of, bird in the hand, time value of money, get as much as you can right away. These are all things that, because you never know, what is happening in the transaction in the world and, whatever else happens, AI, all the things. So, there are people who, sort of spread out the transaction over a period of time, but I think, for our clients, we try to optimize for like, upfront as much as possible. It can, it doesn't necessarily do that. So, for example, if you're always gonna be in the highest tax brackets and, the tax rates are all the same, then, generally from a tax perspective, it's equivalent. But if it's, time value of money, obviously you want, sooner the better. And so, um, that sooner the capital comes to you, the better. So, that's the trade-off. The other thing that one should keep in mind is planning. There's also other things that one can do, more of on a drip basis. And so an example that I mentioned was charitable contributions. And so you can do, let's say in the first year you get the transaction, it's a big number. You could do a big, donor advised fund contribution, and take advantage of the tax benefits there. If you spread it out, then maybe you get other ideas that you could take, like, okay, now I'm going to invest in solar, or I'm going to do a real estate, property or whatever else, and be able to mitigate your taxes in the future. So there's like a lot more time to plan things out. But it's all just kind of like numbers on a spreadsheet that we'd have to like model out for you, and take all these multiple variables and sort of put it on, and determine if it's right for you to do an installment sale or not. But again, it's analysis that we can run. So these are all, very similar to, tax strategies that are available to like high earners in general. And so, I think like the waterfall that we sort of go through first is, what are your goals? We also don't want folks to start a real estate business if they're not wanting to do that, because of the tax benefits, or just because of the tax benefits, or just like moving to Puerto Rico because it's a tax benefits. You don't want to let the tax tail wag the dog. So you want to ensure that we have a good understanding of like what you're interested in doing afterwards from a income perspective. And so that's like, okay, I'm going to start another business. I'm going to take a bunch of losses, to get that set up. That's going to be deduction to me against all this transaction cost. Great. You want to be a real estate professional, that's another benefit, So what do you want to do for income is like the first question we ask. The second is, what do you want to invest in? And so if you want to invest in real estate, again, a lot of tax benefits if you do that. If you want to invest in solar, there's like 2 more years, a year and a half left, but that one could do that and get tax benefits. If you want to invest in oil and gas, a lot of tax benefits there. Um, Opportunity zones, there's value, but like, we tend to think about, these are all separate investments. They all have different return profiles. They have different ideas of risk. And so, another really key aspect of it is that, yes, there may be significant tax benefits, but on the flip side, this is a totally new investment that you have to really kick the tires on and make sure that they're going to deliver what they say that they're going to deliver. And, in opportunity zones in particular, it's a very long period of investment. So you want to make sure that it's really a solid investment. And so, yeah, so generally, the question is, what do you want to invest in? And we'll determine what the most tax advantage structure is for that. The next is location. Where do you want to be? That's going to really, determine, what kind of tax benefits you can get from a state perspective. Next is estate planning goals. And so if you have any goals that you want to set up trusts and, do any other like life planning, life insurance, private placement life insurance. These are all structures that we'll think about. And then lastly is philanthropy. If you want to do any philanthropic, activities, those are all things that we'd have to discuss. There's also like tax benefits and credits that, will sort of surface like, like normally for you, regardless of anything that's going on. So like, child tax credits and, dependent care credits and things like that. But yeah, generally the other things to be talked about are the most important: income, investments, location, estate planning goals, and philanthropy goals. Generally, you want to just have a really good plan in place for how you want to earn income, how you want to invest income, how you want to pass it on to heirs, and then how charitable do you want to be. And so determining what the goals are for the household is first. And then from there, making sure you're set up properly from a corporate structure perspective. You've just gone through this, LLC, S Corp, C Corp conversation. So just, do that again and set it up right this time, if you hadn't before. Second, think about, all the different portfolio income investments that you want to make. Do you want to do a lot of dividend income? Do you want to do a lot of like capital gains and losses? And then, like make sure your state is set up properly. If you are in a world where, your assets are, worth, you know, $10 million or more, now it's time to start thinking about other trust structures to set up. And so, that's sort of a way to think about that. And then lastly, philanthropy, like, in an easy way, you can do donor advised funds. You could do, CRUTs and CLATs and things like that. And you could talk about the benefits of those things. But then the other side of it is that you could start a private foundation, and then, there's a lot of tax benefits in doing that as well. So it's really just like start with the goals and then, go from there, basically.